Hi, my name's Garrett, and welcome to Class 8 Personal Finance. In this video, I want to talk about ESG investing. There's a lot going around about ESG investing. It's popular in a lot of circles. It's unpopular in a lot of circles. What are we even looking at? I should note, I am not a financial professional. I'm just a do-it-yourself investing enthusiast, and my credential, other than a commercial driver license, is a Master of Theology degree. It's basically between the Master of Divinity and a PhD in theology. And so this is where two of my strongest interests sort of collide. Does the Bible mandate ESG investing? What should we be doing about it? How do we go about it? That kind of thing. I'm going to give you my perspective on these things as an investor and as a Christian believer. Let's consider a scripture passage. So this is the first time I've done scripture passage on this channel, but here we go. I'm in Romans chapter 14. As for the one who is weak in faith, welcome him, but not to quarrel over opinions. One person believes he may eat anything, while the weak person eats only vegetables. Let not the one who eats despise the one who abstains, and let not the one who abstains pass judgment on the one who eats, for God has welcomed him. So I have a couple of mandates here. One of them is not passing judgment on one another. If someone has a different opinion on whether to do ESG investing or how to do ESG investing, I have an obligation not to pass judgment on you and vice versa. Now, the second part of this chapter is not causing another to stumble. So don't invest in such a way, show off your investments in such a way that you're going to cause someone else to stumble, cause someone else to sin. And if you're looking at this, you're kind of going, okay, what is this software? What's going on here? This is Accordance Bible software, and it is basically the Bloomberg terminal of Bible software. It's expensive, not quite as expensive as Bloomberg Terminal, but still very, very much worth it. So I'm just going to put that plug out there. So let's consider whether the underlying dynamics of the underlying dynamics of investing mandate an ESG type approach. And before I even do that, I should probably define what ESG is, because there's just a lot of terms out there. And I'm just going to stick with ESG in this video as the term, because the general term might be sustainable investing, at least according to this book that I've been reading through. This is Your Essential Guide to Sustainable Investing, How to Live Your Values and Achieve Your Financial Goals with ESG, SRI, and Impact Investing. So according to Larry Swedroe and Samuel C. Adams, not the founding father, the anti-federalist, there's the overarching term sustainable investing, and then you have three categories underneath that. You have ESG, which stands for environmental, social, and corporate governance. You have SRI, which is socially responsible investing, and then you have impact investing. And so these are the three categories that they say that they work through under sustainable investing as an overall term. Now, SRI was kind of the original one, socially responsible investing. And the idea behind that is let's just screen out all the negative stuff, all the bad stuff that we don't want. You'll also hear the term BRI for biblically responsible investing. And again, once you get into that, now you start getting into okay, are we positively weighting things that are like making a positive impact or not? So let's put it this way. SRI in general, according to Swedroe and Adams, is basically just negative screening, taking things out that we don't want. ESG would involve adding more weight to things that are positive, and then specifically in regards to things that are environmental, social. Usually it's just called social, not socially responsible, because then you start switching categories. See how confusing this is? So things are environmental, positively social, or in terms of good corporate governance. Now, part of this ESG thing is that companies will say, hey, we do ESG because we're trying to avoid ESG risks, such as governments coming after fossil fuel production, that kind of thing. And then there's impact investing. There's this notion that we can have a positive impact on the world by adding more money to things that are good, things that make the world better. I tend to think of impact investing as a bad alternative to just being charitable and donating your money to places that need it more than you do. But we'll get into some of that. But first off, we need to think of what happens when you actually invest money. When you buy a share of a mutual fund, what is going on? Let's go to Vanguard's website for a moment, and let's go to the original publicly available index fund. This is the Vanguard 500 index fund. It was founded, I want to say, well, see, this share class, it says 2000 here. I want to say the original share class was 1973. I could look that up right now, but I'm not going to. But this is a fund that basically tracks the S&P 500. It takes those 500 stocks from the S&P 500 in proportion to how big those stocks are on the market, and it just tracks it. It's a very passive fund as long as you believe the S&P 500 itself is passive. And you can go down here on Vanguard's website, and I don't like the new design. I'm on record with not liking Vanguard's IT. I left Vanguard a while back, a year and a half ago. But you can see Apple, Microsoft, Amazon, Alphabet, which is Google, Tesla, Berkshire Hathaway, etc. And the reason I don't like this site is that you have to go to page 2, do that, then page 3, and so on, instead of just scrolling through the whole thing. There's a way to make that better, but the point being, okay, what goes on when you buy into this fund? The fund minimum for this one is $3,000. It used to be $10,000 for this share class. If you put $3,000 or $10,000, however much, into this fund, is Vanguard going out to these companies and saying, hey, here's this percentage, whatever, this is going to be like 6.2% for Apple. Here's 6.2% of Garrett's $3,000, and we're going to have you invest this. Is that what's going on? No, that's not what's going on. Apple has already issued a bunch of shares, and those shares are out there in the secondary market. So the first thing that I want to just get out of the way in terms of responsible investing, what you're responsible for in terms of what your money is doing, is that your money does not go directly to these companies. And maybe that provides you some sort of moral salve if you have an issue with a company that's within this list. You can already see a controversial company even in this top 10. Johnson & Johnson produces one of the 3 early approved COVID-19 vaccines here in the United States, and it can, if I understand correctly, it contains reproduced fetal cells. So we'll talk about that in a bit. But your money is not going directly to Johnson & Johnson when you buy into a S&P 500 index fund. The shares are already out there on the market. Now, the other flip side of that is what benefit does investing provide to these companies? In larger amounts, if you are a high net worth individual, you may have enough money invested such that your purchase of the stock influences the price of the stock. The more demand that there is for a certain company, the higher that share price is going to get as the shares are being bidded and asked. I'll just leave it at that. Try to keep it from being too complex. So in larger and larger percentages, larger proportions, you could influence the share price of that stock and thus make it easier for these companies to raise capital. For example, when they sell more of their shares. If you bid up the price of a company's stock and they decide, hey, we want to sell some stock and raise some capital, then in a sense, buying that company's stock makes it easier for them to raise capital. But it's not, hey, I'm sending, this X number of dollars to Johnson & Johnson and they're going to do such and such with it. It's not quite like that. So that's one side of the moral equation that you have to think of. What's the other side? The other side is how stock investing pays you. Ultimately, that's what it's about, right? You're putting money into an investment and you expect some sort of return. If you didn't expect a return, then you wouldn't be doing it. So how does stock investing pay you? One is in terms of dividends. Most companies will pay a dividend. I don't know if it's most. I would have to look that up, but you can already see one company here that does not. For example, Berkshire Hathaway historically does not pay a dividend. The second way stock investing can pay you is with capital appreciation. Basically, the price of the stock goes up, or at least you hope. Those are the two basic ones, and I'm just going to leave it at that. I could go into a third one. I'm going to try not to be too complex with this. So, two sides of the moral equation in terms of the money making. One is whether your money goes to the company. That answer is no. And you could affect the stock price of that company and then make it easier for them to raise capital. That's when you have to think about. The other side you have to think about is, okay, this money is coming to you. Is it potentially dirty money to you? Depending on the things that these companies do. Okay, is an example of this would be, okay, here's a classic example. Some guy wins the lottery and he decides to donate to his church, and the church is like, whoa, that's dirty money. We don't want anything to do with that. To your own moral compass, is this the same thing? Taking money from companies that could be doing foul things. Let's talk to us about a second thing within this moral equation, and that is if there is such a mandate to clean up your portfolio and only have companies that are doing good things, clean up the companies off your portfolio that are doing bad things, can you do this in a morally consistent manner? For example, I work for a secular employer. It's a shipping company. An internationally known shipping company. We ship to pretty much everywhere in the developed world, and we have all kinds of customers. We have false churches that are customers. I'm pretty sure we ship to abortion clinics. I've never heard of anything saying that we don't, that kind of thing. So this company does this kind of stuff. It makes money doing it, and then they pay me. Is my salary dirty money? You might have to chew on that. You have a savings account, I assume. That bank isn't morally screening its customers, the customers to whom that they're giving loans. So this bank is taking the money that you have in your savings account and it's loaning some of it out there, and then it's getting a return on that from dirty customers, and then you're getting a return from that. Is that dirty money to your moral compass? Health insurance. There's all these, Christian health sharing things out there, but what if you have just secular health insurance? I have secular health insurance. I don't even pay a premium for it because I'm in a union. Yay. Am I morally culpable for that? Because that's part of my compensation package. Government bonds. Name one person of sound mind in the United States who thinks that everything, literally everything the United States government does is moral. Good luck with that. But if you invest in government bonds, well, the government is taking that money that you're lending them and doing things with it. So are you now culpable? Where am I going with this? As long as you live in an economy with fellow sinners, there's going to be quote unquote dirty money, and you need, I would just encourage you to think about in terms of your moral compass, in terms of your standing with the Lord, where you want to be on that. Where is your conscience? And again, I'm referring back to Romans 14, and I don't want to just throw people under the bus or make fun of them if they come to a different conclusion than I do. So just think about that in terms of your moral compass. Now we're going to get into some technical stuff because I want to look at whether Christian investing products accomplish what they claim, because there's a bunch of Christian investing products out there that are like Christian mutual funds that say, hey, we screen these things out. So let's say that you've gone through this whole moral process where you said, okay, I really do want to filter Johnson & Johnson out of my portfolio. I really do want to filter out the alcohol, the tobacco, the pornography, the abortion, things like that out of the portfolio. And I need to find a product that actually does this for me. Okay, so how would you go about doing that? And you have to think of some questions in regards to that. One is, do these funds screen out everything that should be screened out? Two, do you want them to overweight what things that should be overweighted? Do you want to have some sort of impact weighting in there? And then finally, is their performance similar to or better than their secular counterparts? After all, you're investing in order to make a return. Presumably you have some sort of goal, and 99% of the time in the context of this channel, it's going to be retirement. And so you have to look at the holdings, like we're looking at the holdings for the Vanguard 500 fund here. You have to look at the holdings to really know what's going on. And let me show you the why and the how. So let's go to one leading fund provider, which is Guidestone. Guidestone is basically owned by or a portion of the Southern Baptist Convention. So the largest Protestant, I think it is the largest denomination in the United States. And somebody will come back at me and say, the Southern Baptist Convention is not a denomination. It doesn't even exist except for this little portion of the year where they have the annual meeting. It's a denomination. All right. So they have this president here who is not a financial professional. He's a pastor. He's like a 30-year pastor. This guy, O.S. Hawkins, was the president prior to that. He was a pastor prior to that as well. So they've got this whole Christian thing going on. They've got the Christian cred, if you will. You've got a chief operating officer who actually does have financial credentials. He's got a CFA. This guy's got a CFA, CPA, that kind of thing. But the president is typically a career pastor. So you look at Guidestone's website here, and it says faith-based investing. And again, we have the negative and positive thing going on here. Note here, Guidestone Funds does not invest in any company that is publicly recognized as being in the alcohol, tobacco, gambling, pornography, or abortion industries, or any company whose products, services, or activities are publicly recognized as being incompatible with the moral and ethical posture of Guidestone. So there's the negative screening aspect going on. There's this positive thing going on here. Advocacy is the next step. So they say, hey, we advocate for our shareholders through letter writing and corporate dialogue. And it all sounds good so far. So I'm not going to be able to go through every single Christian product that's out there or every single company, but at least I want to show you the process. I want to go through a few of the products and at least two of the companies. I might go through a third here. I don't edit these videos. I really don't want to. So let's go through that process here. So you got the negative, you got this positive for shareholder advocacy with boards, and then there's this impact investing thing that they have going on. And you can look at their list of funds here, and this is a little difficult to navigate if you're not familiar with investing language. Like, how would you start looking at this? One thing I'm going to note, this is important as to the direction I'm going in this video, is that Guidestone does not give us a list of the securities that they filter out. An actual list of securities, like we don't invest in Anheuser-Busch because they brew beer. We don't invest in Pfizer because they used fetal cells in their testing of a vaccine or something like that. But what we can do is look at least one of their index funds, because note remember what I talked about an S&P 500 index fund. It just takes those 500 stocks and just invests in them. Well, Guidestone has an S&P 500 index fund as well. And this is the part where I patch myself in with part 2 or recording 3 actually of this video because my microphone froze and I didn't know it while still talking and looking dumb in the raw video. But we're back in Guidestone's equity index fund, and we know that this is an S&P 500 index fund. We also know that it has 483 holdings. The 500 refers to the number of stocks in the index, so you can already tell by process of elimination that something is missing from here, and that's by Guidestone's design. That's not a negligence thing. So how do we know what's missing? Again, as I said before, I believe we don't have a list from Guidestone that says we don't invest in this, we don't invest in that, these particular securities. But we can see what they took out of the S&P 500. And so as an object lesson and as a lesson on how to check the holdings yourself, let's see how to do this. In the case of Guidestone's website, they don't make this very easy. For one, it's a terribly designed website because you can see there's all these vertical lists that are horizontal to each other, and I have a horizontal screen right here, and so I can't even see everything that's going on, but I can see parts of what are going on 4 different things. Maybe 3 different things in this particular case, but you get the idea. Redesign your website, guys. But you can see the top 10 holdings right here. Apple through Procter & Gamble. And if you have a photographic memory, you'll recall back over here at the Vanguard 500, this had Johnson & Johnson. This does not. Johnson & Johnson is gone. Guidestone took Johnson & Johnson out of their S&P 500 index fund. I did some research on this fund before, back when I wrote for a Christian blog called Things Above Us. And I remember Johnson & Johnson being there. I looked through some old lists of holdings, and Johnson & Johnson was there. It would appear Guidestone is at least looking at this from time to time because Johnson & Johnson brought out a COVID-19 vaccine that I believe contains reproduced fetal cells. That was one of the controversies with the COVID-19 vaccines. And so you can see Johnson & Johnson is no longer in this S&P 500 index fund, even though it's the 9th biggest stock in the S&P 500. But this only shows the top 10. You've got another 490 stocks to worry about. So let's figure out how to do this. You can't do it on the web page here, but you do have these shareholder reports at the bottom of the page, and this is where it gets tricky. I am recording this on the very early morning of August 1st. So you would think, okay, we want to look at the second quarter portfolio holdings because the second quarter ended on June 30th. But if you click this and you download the report, you'll notice that this says June 30th, 2021. So it's old. And in fact, I could probably hit Control F here and type Johnson. And you can see Johnson & Johnson. Those are actually bonds right there. But you can see Johnson & Johnson stock right here in one of the funds. That's also bonds. But here, which one is this? Defensive Market Strategies Fund. But you get the idea. There's still Johnson & Johnson in this PDF. If I can find it, yeah, Equity Index Fund right here. And you see Johnson & Johnson right there and a substantial amount of it. Johnson & Johnson was in the Equity Index Fund as of last year. And we can check it in a moment and see if it's still there. Point being, you want to make sure you have the most recent one, and it's actually not the second quarter one as of August 1st. It's actually the first quarter one. That's the most recent. So let's open up this one. And you can see, check the date on the PDF, make sure it's at least the most recent one you can find. This one is March 31st, 2022. And I can go ahead and just do another search for Johnson And see, I got Mead, Johnson Nutrition, Johnson Controls, Johnson Matthey, and that's it. Johnson and Johnson is no longer there. So there is some sort of periodic process when they actually, screen some things out, or they saw something in the news and decided, okay, this one needs to go. So there is some sort of moral screening going on. Now, let me show you. Here's the equity index fund, and I can go ahead and scroll to the top here for a moment and kind of pre-stage it. So this is the first page of that. So you notice Global Impact Fund right here. And so equity index fund, this is the first page of the S&P 500 funds schedule of investments for Guidestone. Now, let me what you could do is go through every single stock, and I would probably tell you to do either the Vanguard Advisors website. Where did that list of holdings go? Oh, because I typed in win. That's why. So you could use this list right here. There's also a Wikipedia page that has all the stocks of the S&P 500. That's pretty useful as well. You can go with that one too. Go through every single one of these and see whether it is in the PDF that Guidestone puts out. You could do that, or I did it for you. So let me hold this. So here are the S&P 500 stocks that are not in Guidestone's S&P 500 index fund. This will give us a good idea. Altria Group is basically the Philip Morris within the United States. There's also Philip Morris International, which is the Philip Morris stuff outside of the United States. You're talking about tobacco, and I think Altria Group might have some involvement with alcohol as well. In any event, it is screened out of Guidestone. Biotechne, something to do with fetal cell lines, I want to say. Brown-Forman is alcohol. Caesars Entertainment is obviously gambling. Constellation Brands is alcohol. Cooper Companies manufactures a copper IUD, and that is thought to work by preventing the implantation of a fertilized egg. Now, this is stuff that I researched to find out about these companies. Again, Guidestone does not put out a list like this or to say, hey, we screen this out for these reasons, but we can look at these companies and kind of make a reasoned assumption of what they're doing. Johnson & Johnson, we talked about. Las Vegas Sands has Las Vegas in its name. It is gambling. MGM Resorts, also gambling. Molson Coors is beer. Penn National Gaming is gambling, obviously. Pfizer was screened out, but it was screened out back in that 2021 report that I showed you earlier. So it is not in particular the COVID-19 vaccine that caused Pfizer to be screened out. I want to say it had something to do with, I'm forgetting the name of the drug. It starts with M, and it could be used as an abortifacient. So that's why Pfizer got screened out, as I understand. Philip Morris, we already talked about. Wynn Resorts, I mentioned that one before, gambling. Wynn has a casino hotel in Las Vegas. And this might all be well and good with you. You might be looking at this kind of going, okay, good. I don't want this in my portfolio. This looks good so far. Okay. Well, let's talk about what else is in this fund. And I can go to this list for a moment. So I would encourage you, if you're whenever you're considering a fund and you're talking about morally screening it, look through this first, look through the PDF, and just kind of make your own common sense check. And the common sense check here for Guidestone, I must say, is not in their favor. So you can look at this right away, and the first thing I can bring to you right away is Discovery Inc., as in Discovery Channel, Discovery Plus, etc. They recently purchased the assets of Warner Media from AT&T. And I'll note, back in 2021, when I did some research on this, both of these were already there. So there's nothing's changed about this in a while, even though the Warner Media assets were transferred in a sale. Warner Media, well, what's wrong with that? Okay, well, 4 years ago, the whole conversation on Twitter, I remember, was that Game of Thrones is pornography. Well, Game of Thrones is part of Warner Media, and that's in there. Pretty much everything HBO is within Discovery Inc., as I understand it right now. So if you can think of things in HBO that you don't want to be invested in, that you don't think a Christian mutual fund that says that they screen out pornography should have stock in, then this might not be for you. And in any event, AT&T, Charter, Dish, I think there's going to be another one down here. Maybe not. But you get the idea. Those are basically cable providers. Omnicom, I'm going to guess, is a cable provider. I haven't verified that. But cable providers are going to be providing all the channels and pushing out all the things that channels do. And I know there's going to be something there that you don't like. Comcast. I didn't mention Comcast. That was probably what I was thinking of. Fox Corporation. You can think of things on the Fox broadcast network that aren't so kosher, things that probably don't belong in a Christian mutual fund that says they're screening things out. Live Nation includes live music of questionable morality. I'll leave it at that. Match Group operates a large series of dating websites. And let's say the dating websites aren't morally screening the types of relationships that are there. Netflix was indicted by a grand jury in Tyler County, Texas for distribution of CP. If you remember the movie Cuties and how much of a ruckus that caused on social media some, want to say, year and a half ago, it's still there. I don't have Netflix, but I went to a site that lists out what Netflix has, and at least according to that site, that movie is still there, even after all the controversy where people trying to get Netflix to pull it, and everybody was telling Christians, "Hey, stop subscribing to Netflix because this is what you're supporting." That kind of thing. And by the way, I'm just going to make the point now about consumer habits. Okay, if you're going to say, "Hey, I can't invest in a secular mutual fund or a secular ETF because of these things that are being supported," I would also say, hey, think about your consumer habits as well and the other things that are in these corporations that are being supported. So let me pull up, see, Procter and Gamble is right here. What's wrong with them? Remember that ad that Gillette put out that says, "Is this the best a man can get?" And it's got these kids fighting, and it got maligned as being this woke thing. And you had all kinds of Christian social media accounts saying, "I'm never buying a Gillette razor ever again." Well, Gillette is owned by Procter and Gamble, which still, okay, did you get rid of your Head and Shoulder shampoo? Did you get rid of your Tide laundry detergent and your Cascade dishwasher detergent? That kind of thing. Does a woke ad from Gillette mandate that we just abandon all Procter and Gamble products and go to someplace else and go to alternative products where those companies making those alternative products are also doing some woke things in their advertising as well? You got to think about these things. That's what I'm saying. So we talked about Netflix. Let's see, Paramount Global. That is basically a renaming of Viacom CBS. So you're talking about MTV. You're talking about some serious nonsense going on in CBS. You're talking about Nick Jr. And if you remember what Nick Jr. has been doing with Blue's Clues, and that involved a pride parade with a cartoon character in drag singing through it. Two little tiny babies, toddlers. Okay. Take-Two Interactive Software. They put out the Grand Theft Auto series of video games. Apparently, they are going woke, and they say, hey, the Grand Theft Auto series is going to be more respectful of women now. Right, and you're still deriving entertainment by shooting at police officers. Is that something that should be in the Christian Mutual Fund? Now that they're getting better at it, I guess. Disney Plus. I mean, we've all been through that on social media as well. So these entertainment type ones, these communications type ones, are kind of the obvious ones, and nothing communications wise got screened out. from the S&P 500 in this fund. Less obvious ones. We talked about gambling. Okay, it said the word Las Vegas in it, therefore it's gambling, right? Carnival Corporation right here. I'm going to zoom out right here. Carnival Corporation. I've got Norwegian Cruise Line Holdings here. I've got Royal Caribbean Cruises. If you've never been on a cruise, you might not know this, but these cruise ships are floating casinos, or at least they have casinos. I was on a cruise ship with it was Celebrity Cruises, which I think is a division of Royal Caribbean, and an entire deck of the ship. I'm in the 8th deck, so think of it as a story. I'm a Navy veteran, so I'm going to call it a deck. But the entire deck of this cruise ship was casino. So I remember I was 21 at the time, so I was legal to gamble, but I didn't gamble. My younger brother is 8.5 years younger than me. Clearly not allowed to be a casino, and I was hanging out with him most of the time. And so I just remembered, okay, don't go to X floor because it's a casino. But it's in the Guidestone Fund. I don't want to get too sidetracked, but the whole point is they should be, screening things out at least screening things out that they say they're going to screen out. And if you think Cuties is CP, then Netflix should be, well, I should say Guidestone should be screening out Netflix if Cuties is CP. Let's keep going. And I'm going to go to finally, let's go to the whole list that I made. So I talked about pretty much most of this entertainment stuff. Moderna tested their COVID-19 vaccine on fetal cell lines, which is not the same thing as Johnson & Johnson actually having fetal cells in the COVID-19 vaccine. However, if I don't want to like try to draw some really, really sharp moral distinction between those two things, but I'm going to generalize and say, the same investor who doesn't want Johnson & Johnson in the portfolio also does not want Moderna in the portfolio. I think that's fair to say. So let's keep going with that. I'm going to look through my notes and make sure I'm doing this right. I've got one more thing to show you, and I don't want this. I really don't want to make this a PowerPoint channel. I really have a whole slideshow of like, I'm showing 67 slides here. I'm not going to show you 67 slides because I'm just going to lose people and this is going to be really boring. But I've got this one. These are other portions of Guidestone's report, and I'm going to show you on the PDF itself. Let's type here Gazprom. So you can look here and see Russia, and this is in the Emerging Markets Equity Fund. Russia was an emerging market earlier this year until they invaded Ukraine. A second time, I should know. And you can see here all these Russian stocks. You might think, okay, you didn't necessarily need to filter out Russian stocks because, well, it's not like these companies are doing the persecution of Christians or whatnot. Okay, fine. But you would have wanted to know that before you invested in the emerging markets fund, at least I would say. And you'll note that these dashes here are just dashes, and the same column has values. And I think these are in thousands of dollars here. It's not. Oh no, that's not. It's not thousands. It's actually actual dollars. It appears, but they're all dashes right here. In other words, they're worthless. So if you were invested in this emerging markets fund with Guidestone, at least that portion of your investment is completely gone, which is why it says 0.0. So you'd have to look at a previous one to see exactly how much of your fund you lost between. So you could look at the end of year 2021 report, and then this one for March 2022, and you can figure out what percentage you lost just by Russia even being there. Let's talk about another that was on there, China government bond. There's one right here. There's another whole list right here, and this is within, which fund is this? global bond fund. So it's the global. Usually when we say global in investing, we're talking about US and outside US. So I'm just going to double check that. I see Ukraine on there. United Kingdom. I'm probably getting sidetracked here. I'm just going to come back. But in any event, China government bond, China government bond. Okay, the Chinese government is literally a persecutor of Christians. What did Guidestone's thing say? It said, any company whose products, services, or activities are publicly recognized as being incompatible with the moral and ethical posture of Guidestone. Okay, so China is not a company, fine. But I would say that the Chinese government is publicly recognized as being incompatible with the moral and ethical posture of Guidestone. I mean, unless it's not. Unless you're saying that the Chinese government's persecution of Christians is okay with the Southern Baptist Convention. I don't actually think it is. I'm not trying to throw the whole SBC under the bus here. I'm definitely throwing Guidestone under the bus. No problem. But let's go back to this. Saudi Arabia. In fact, I think so. Not merely Saudi Arabian companies. You can see Saudi Arabian companies right there, but Saudi government international bond right there. So when you're talking about bonds, okay, that's literally. Well, I mean, even those bonds are put on the secondary market, but the effect there is lending money to the Saudi government, lending money to the Chinese government. Okay, we weren't thinking about this. We're thinking about the social uncomfortableness of investing in an alcohol company, a tobacco company, a company that in part manufactures abortifacients or uses fetal stem cells, that kind of fetal cells, that kind of thing. But this just wasn't thought through. And so if this is an issue in your moral compass, so it's like, okay, I can't have any of this in my portfolio, even if it's a small percentage. I just can't do it. Okay, I'm not going to throw you into the bus. I'm not going to make fun of you. But I am going to point out these things are can be in there, and they can sneak in if you're not careful. So that's why I'm putting that out there. So what are some tools you can use? Actually, here's what I'm going to do. I'm going to talk about fees. I'm going to talk about fees for a moment because note here. So we're going to talk about the financial side for a moment. The fee for owning Guidestone's equity fund is 0.39%. And if that's 0.39% per year, and that may sound high or low depending on how familiar you are with investing in the first place. You look at Vanguard's 500 index fund. And note this is the mutual fund, not the ETF. The mutual fund will charge you 0.04% per year. So you're already losing 0.35% of your investment per year simply by going with the Guidestone fund instead of the Vanguard fund. And obviously you should think there's at least a little variation based on the stocks that Guidestone screened out. So part of your calculation in your head as to what kind of fund you want to go through is, okay, I'm looking at this Guidestone fund. I'm interested. It screens some things out that I don't like. It fails to screen out some things I don't like. And the fee that I'm effectively paying for the service of screening out some of these things is 0.35% per year. But let's also see what's going on with Guidestone in general. And for that, we're going to pull up Portfolio Visualizer. Portfolio Visualizer is a pretty nifty tool. There's a free version and there's a basic version. Let me pull this up real fast. This part the basic costs $19 a month, the pro costs $39 a month. I stick with free. I just don't think there's enough here for the vast majority of individual investors that you need to pay $19 a month. But I'm just putting that out there. I'm just going to confirm the resubmission of the form here. Okay, so my stuff is still saved, and that's good. So here's the scenario that I'm bringing up here. We're going to start with $10,000 at the inception of Guidestone's equity index fund. Guidestone, if I call it Guidestone 500 because it's an S&P 500 index fund, and it is, that's what I'm referring to, Guidestone Equity Index Fund. We're going to start with $10,000, and we're going to contribute $5,000 a year. So this is going to be a reasonably realistic scenario for an investor. $5,000 contribution frequency is annually. Don't worry about the rebalance part because each of these portfolios is going to be its own thing with just one fund in it. So if you're setting this up yourself, you can hit the what's this thing called? It's called a magnifying glass, Garrett. And then you can go hit mutual fund and type in Guidestone Equity Index. And then when you get to here, you'll want to make sure you hit the investor one because you hit INSTL, that institutional. And I'm assuming you're not an institution because, well, this is YouTube. And I assume you're a human being, you're just a normal investor. The institutional fund has a minimum investment of $1 million. So if you don't have $1 million to just stick into a fund, you should probably, do the investor share class. These are just two share classes. You would go with the investor one when you're setting up this scenario yourself if you're doing the testing. So I have Guidestone's fund here, and I have Vanguard's 500 fund here. And this is to test out how these funds compare with each other in terms of performance. And you can see down here, I already have it tested out. These lines are very, 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 very close to each other. In fact, I can turn off the logarithmic scale, and they track reasonably well with each other. And you look at the numbers. Guidestones ended up with 376,000 or so. Vanguard's ended up with 392,700-ish. So there's a difference of about $15,000 to $16,000 between the two, which is, frankly, not that bad, if you will. So you do need to consider, okay, and this is going to sound stupid and shallow. It costs you $16,000 to screen out these stocks. Okay, that is part of the calculation, and if it's obvious to you that it would have been worth $16,000 to you, hey, great. But with the note of the fact that Guidestone did not screen out a lot of things that really should have been screened out, at least by the standards that they state, and at least by standards that I think ought to be consistent. You'll also note, take a look strongly at TWRR here. This stands for time-weighted rate of return. And what that basically means is the rate of return of the investments without the additional cash flows that we brought in, those $5,000 contributions. So basically, it's how the funds actually did, and we're not going by the additional weight of the funds coming in every year and then making the later years more important than the earlier years. 8.51 minus 8.15. I'm going to try to do math in my head, is 0.34. Am I getting that right? 41, 36. It's 0.36. 0.36 is the difference between these two funds. Now, what was the fee on this? The fee on Guidestone was 0.39, and the fee on Vanguard was 0.04. So that's only a 1/100th% difference when you take the fees out. In other words, Guidestone's screening out of those stocks that we saw earlier, the alcohol, the tobacco, the really obvious things. Guidestone's moral screenings didn't have a substantial impact on the performance of the investment. So keep this in mind. Let me say this again. The moral screening out in Guidestone's Equity Index Fund and Guidestone's 500 Fund did not substantially affect the investment one way or the other, but the fee did. The fee cost the investor somewhere around $15,000 to $16,000. And that's, I mean, when you're trying to meet a financial goal, maybe that makes the difference for you. But Guidestone's fund, the equity index fund, Guidestone's 500 fund, is not the only thing going on in their investments. You go back over here. I guess I set both of those tabs to the same thing. We're gonna go back to the our funds list. So I chose that index fund for comparison purposes because it is an index fund, and because Guidestone does not give us a list of the bad stocks that they do screen out. You've got other funds going on here. You've got this value equity fund, growth equity fund, small cap equity fund, defensive market strategies, which is a marketing term for market timing. Market timing is stupid. Don't do it. You've got this international equity index fund, which only became available to individual investors last April. Prior to this, one of my huge criticisms of Guidestone was that this equity or this international index fund, that by international I mean outside the United States. The United States is a nation, last time I checked, but you get the idea. This was only available at the institutional share class, and so you had to have $1 million to do this one. So good on Guidestone for at least getting the fees down for folks who want an international index fund within their Guidestone accounts. Because note the net expense ratio on this is 0.51. Don't worry about gross, because basically when you see a net expense ratio, they're waiving the rest of that. So hopefully they don't bring it back up to 1.64. But the net expense ratio here is 0.51 versus a 1.15, a 1.34. You go back up to the US funds, you've got 0.90, 0.91. You got a 1.17 for the small cap one. I have a small cap fund that's a lot less than that because it's an ETF. It's more like a point. I think the largest small cap expense ratio I have is like a 0.35. So these are expensive. These are expensive funds, and there's still substantial assets under management within these actively managed funds. So let's talk about these funds too, because I think that calculates into Guidestone in terms of being an overall firm. So here's another calculation I made. We're back in Portfolio Visualizer, and we have the same scenario. We're starting with the inception of these Guidestone funds. These were incepted on August 27th, 2001. Initial amount, $10,000, $5,000 a year contributing annually. So not just an initial $10,000. And I have 3 funds here. One here is Guidestone's S&P 500 Index Fund. We're going to use that sort of as our benchmark. And then we have Guidestone's Growth Fund and Vanguard's Growth Index Fund. Why are we doing this? Well, there are growth stocks and there are value stocks, and this is real basic stuff. If you're familiar with investing, you already know this. Growth stocks are stocks that tend to look overpriced compared to their fundamentals, whereas value stocks look underpriced compared to their fundamentals. So, for example, Tesla is a growth stock. Up until the this past downturn. Here in 2022, Tesla seemed to be like the growthiest growth stock ever. At one point, they were trading at 35 times their book value. In other words, you buy one share of Tesla, and it costs 35 times what that share costs on paper in terms of their assets minus liabilities. Tesla is, fancy and exciting, right? AMC and GameStop, well, those stock prices went up. They're fancy and exciting, and so they became growth stocks, right? Ford, no one cares about Ford. Ford is a value stock. No one goes to parties and go, hey, check out my Ford stocks, right? Ford, at last check, was trading maybe like straight one. It was like one share the price of one share equals the assets minus liabilities of that little piece of the company. That's the difference between a growth stock and a value stock. And the reason I bring this up is growth stocks outperformed value stocks over this period between September 2001 and July 2022. So when you analyze this out, I guess this says January 2002 to July 20. Dude, did I mess that up? You know what? It's because one of these funds was incepted. You know what? I'm not sure. You know what? It's because I selected year to year. If I'd selected month to month, it would have done that, but we're not gonna sweat that. But let me show you what happens. So you have, let me zoom this out for a moment. We're not in logarithmic scale, and so you can see huge differences right here. The winner is by far Vanguard Growth. Now, that is not something that you should criticize the Guidestone 500 fund for, because by definition, the S&P 500 is about half growth, half value, because it attempts to be an overall look at large stocks in the U.S. market, and so you're going to have a growth side and you're going to have a value side. So you shouldn't, when growth stocks outperform value stocks, you shouldn't look at a blend of those and kind of go, "You stink." Don't do that. I hear my kid cry. I'm going to pause the recording. And I'm back. So let's think about Guidestone versus Vanguard in terms of being growth funds. So remember time-weighted rate of return here. The rate of return based on just being invested in the fund as if you had just put $10,000 and had never put anything in. So this doesn't put any additional weight based on the cash flows going into the funds after the initial investment. You have 7.55% on the Guidestone Fund and 9.25% on the Vanguard Fund. And note, Guidestone's fee for the growth fund, I think, is 0.90, 0.91, even worse, but only marginally. So if you added 7.55, I don't feel like doing the math right here. 7.55 plus 0.91. In fact, when I was going through the math earlier, I had already put this into the calculator. 8.46. So if Guidestone had done this for you for free, it would have made 8.46%, whereas Vanguard's would have made 9.25%. And again, the moral screening made virtually no difference in the 500 fund. So why would it in the growth fund? So what happened here? Why did Guidestone underperform Vanguard by this substantial amount, almost a full percent? And the answer to that is active management. The Guidestone Growth Fund is not an index fund, it's an actively managed fund. And if you look through the info on the Growth Equity Fund, you can find that it has these 5 different sub-advisors that are trying to do 5 different things. I'll bet the Guidestone Capital Management one is like the money market portion of the fund. That's just like the free cash that they have for the other companies to mess with. Let's call it 4 sub-advisors. And so they're paying these 4 different companies to do 4 different things in terms of growth to try to make this thing perform well, and perform poorly. It did, and with a higher standard deviation. In other words, it had more volatility risk. It had more up and down versus the Vanguard fund, and yet performed much worse. And on top of that, investors in this fund paid 0.91% versus what they could have been paying in the Vanguard fund, which I think is 0.05%. Let me look that up in my notes right here. Yeah, 0.05% for the Vanguard fund. That's pretty bad. It's an odd story on the value side also, but not in the same way. So here's the Guidestone 500 fund. Here's the value fund. Now, value stocks underperformed growth stocks. And so you should expect the value funds, both of them, to underperform Guidestone's 500 fund, which is effectively a blend of growth and value. You can see that Guidestone's value fund underperformed Vanguard's value fund by a pretty substantial amount. I don't feel like doing that math right now. 337,941 minus 289,979. So you're missing out on $48,000 after all that investing. But what happened here? Now, the fee on Guidestone's value fund is 0.90%. That's pretty easy math. Guidestone's value fund, if it had been free to invest in, and of course, this is all assuming standard fees being constant. So let's at least make that clarification. Fees being assumed constant, because it's hard to go and look up historical fees and get that all exactly right. If Guidestone's value fund had been free, it would have made about 8.08%. So in fact, Guidestone's value fund, if it had been free, would have outperformed Vanguard's value fund, even with Vanguard's fee being 0.05 here. Guidestone's active managers on the value fund actually slightly outperformed the Vanguard fund. However, they had to be paid. Workers deserve their wages. That's in the Bible. 0.9% fee caused the Guidestone's value fund to underperform Vanguard's value fund. So what are you even purchasing with the Guidestone fund? Well, you're purchasing, the moral screening to that certain degree, but let's put it this way. And I should have brought up an image to put here just to really illustrate the point, be a fancy YouTuber. Guidestone is the Beyond Meat of Christian investing. Why do I say that? Well, here's the criticism of Beyond Meat. And I'm not a health food guy, so maybe I'm not going to be entirely accurate or full here. But Beyond Meat is one of those GMO meat alternatives. And so what will they say? Well, they don't advertise, hey, we're genetically modified. Isn't that great? No, they go, well, this is a good source of a plant-based diet. You can, make this your plant-based protein. And the health food folks will go, well, no, you're genetically modified and people are having kidney problems or something. I think I've heard that about some of these GMO alternative meat products, but okay, don't quote me on that. This is an investing channel, not a health food channel. But you get the idea. Guidestone is basically Beyond Meat. They're basically saying, okay, hey, this is faith-based investing. This is what we're about. We're according to your values. And not only do they just not do a good job in the first place with the values part, but what you're really buying is, instead of kidney problems, you're buying bad active management. And you're buying high fees. Bad active management, certainly in particular to this growth fund here. The value fund, okay, they did a decent job, and I'm not going to go into exactly how they did it over the years, all that, whether it was luck, whether it was, hey, they were less value-y than the Vanguard fund. They might have been larger than the Vanguard's value fund. I can't look that up right now. But you paid 0.9% to the point that you underperformed the Vanguard fund. So was the moral screening worth it for that? Only you can answer that. What other alternatives are there? What tools do we have? So here's one thing I want to point out. This is called Inspire Insight, and this is at inspireinsight.com. And you have to love what they brought up right in front. Trending issues, companies paying for abortion travel. And there's this whole list right there. And I'm going to look through here real fast and see if any of these stocks were ones that Guidestone screened out, and it's basically none of them. I looked here. So, I mean, I see stocks that we talked about. Match Group. We talked about Netflix. We talked about Procter and Gamble. We talked about Disney, etc. Well, they're all here. Now, to be fair, the paying for abortion travel thing happened after March 31st, 2022. So we'll see if Guidestone does something about this in their funds. But, don't hold your breath. I think it's just going to be the status quo. Now, what you can also do with this tool is look up mutual funds, ETFs, and individual stocks. Now, I happen to know that GEQZX is the one for the Guidestone Fund, and if you don't know where to find that on Guidestone's page or whatnot, you can see it right up here. Mutual funds are always 5-letter tickers, and they always end in X. That's just the easy way to remember that if it's a mutual fund. If it's an ETF, not so much. But it's a pretty nifty tool. Let me go through it. So you'll note that they still have kind of a secular ESG thing going on. So if you're a typical, right of center Southern Baptist, then maybe the environmental stuff isn't for you as much. You're going to be a little skeptical of, hey, physical impacts of climate change. And then there's 74 securities here. And they say, hey, these companies do a good job with the physical impacts of climate change. And the tool also lets you dig in. So let's say, I'm going to click Microsoft just for a moment. And then see what they're doing for the physical impact of climate change. Best in class. Ooh. This company ranks 52.51 in its physical impacts of climate change industry peer group percentile according to True Value Labs. And maybe that matters to you and maybe doesn't. But their Inspire Impact score is -81. Why? Well, 4 social things, 16 on LGBT philanthropy, 3 on LGBT legislation, 1 on LGBT promotion. More on that in a sec. I'm going to go back here to the Guidestone 500 fund. Okay, my computer's a little slow because it's recording video. Under social here, employee health and safety, best in class. Data security, best in class. So it's got all the positive stuff. But the way this Inspire Impact score works is that if there's absolutely anything negative over here, the score is negative. It's not going to count any of this positive stuff. It's not kind of a weighing of the positive versus the negative. That's not how they're doing it. And so you look under negative social. Inspire Insight is run by an evangelical team. And so you have negative scores here for LGBT philanthropy, legislation, promotion, etc. Abortion, philanthropy, pornography, etc. And you whittle it down. You've got 3 for abortive actions here. By the way, this is the Guidestone Fund. Under the Guidestone Fund, CVS Health, Organ Non Viatris. I'm going to say CVS Health is probably because they sell Plan B in the store. And I should have probably just put that on the list. So now Plan B isn't a huge part of CVS's business, but it's part of the business. And so you had to think about that in terms of your investing decision, whether you want to be in that Guidestone 500 fund. That is a decision that only you can make. But this tool, pretty helpful. I'm going to say the Inspire Impact score is not helpful to me at all. But the negative stuff right here that they bring out, okay, it's a really nice way to kind of whittle through the holdings and kind of figure out where it is. I found the gambling one to be really interesting as well. I pointed out the cruise lines thing, Royal Caribbean, Norwegian Cruise Line, Carnival Cruises. That one just stuck out to me because I've been on a cruise ship. Electronic Arts comes out here okay, that makes sense to me because they probably got like some sort of mobile game that's based on casinos or something like that, and maybe there's some actual gambling going on that they're involved with. They brought up Hilton and Marriott also. I'm guessing they own some sort of casino hotel, something like that. If we could, dig into that and find it. So, Inspire Insight is a pretty good tool for finding these kinds of things. Now, let me go over. I guess I did pull it up in a tab here. So this here is another side of Inspire's business. They own a series of ETFs. And so I've seen their CEO, Robert Netsley, go on the Eric Metaxas radio show. And this is not Netsley's fault, but it felt kind of coy because the moment you start talking about your ETFs, then on a radio show or on an interview or something like that, you're under all kinds of SEC regulation where you have to say, hey, you have to read the prospectus, read and consider carefully before investing, da 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 da. And there's probably just no time room on the radio show to go through all of these disclaimers or something like that. So I am not maligning the character of these guys at all when I say this. But this insight tool partially is a means of advertising the ETFs. So you go over here to top scoring funds, and anytime you see Northern Lights Fund right there, that's basically the distributor, I guess, of these Inspire ETFs. So obviously, their own ETFs are going to have positive impact scores. So look at, BIBL, I think, is the one with the most assets under management. In fact, I can just click it right here. And then you can see no categories on the negative side, and then it's 53 on the Inspire Intact positive side. So you can look under environmental and all of that. I've already shown that to you, but you get the idea. So if you've ever wanted to own an ETF with the ticker symbol WWJD, well, you're in luck because it actually exists. Now, how good of a job do they do by their own standards? I'm going to say that this is questionable, and here's why. You look at BIBL, and you see all these positive things, and you look at Prologis Analog Devices. So these are the holdings that they have. And let me put it this way. It's August 1st right now. I started researching for this video back in June. I've been trying to make this video for the longest time. Let me just go ahead and pull it up. I'm going to put my old slideshow in grid view here. And what I did is I went on Twitter and I looked through the Twitter accounts of a bunch of these companies, and oh man, let's do this. Okay, I'm just gonna go ahead and do it. I'm gonna drag this over here. All right, and you can see what's going on here. I took a screenshot of BIBL's holdings here, and these holdings are going to be substantially similar to what they are now. This screenshot here is as of June 24th, and I basically went to the Twitter account / social media of the companies in these top 10 holdings. Now, remember, we looked at. Let me go back here. We looked at the Inspire score for Guidestone's Equity Index Fund, and we saw these categories, including LGBT philanthropy, legislation, promotion, etc. And so you could easily just go into this one. Okay, Salesforce. And they say negative social impact, minus 77. And LGBT philanthropy, legislation, promotion, etc. You can click view details. Salesforce and its subsidiaries, Slack Technologies, are supporters of United Nations and World Economic Forum LGBTI standard of conduct, which was developed, et cetera, et cetera. So here's the thing. You go to BIBL. I think I'm taking too long to explain this. And did I see Salesforce here? I might have. Maybe. I did. I'm thinking a different company. But note what I did here, and you probably get it by this point. ServiceNow, still doing LGBT promotion. Prologis, they run business warehouses. Like if you have a business shipping things out from a warehouse, there's a good chance that's Prologis. They're a commercial real estate investment trust. They had their own thing going on, and sometimes you could dig into these companies, and all these screenshots here are companies that are in these Inspire funds. So now, here's the thing. So by Inspire's own standards, is this an issue? I noticed in one of their funds, FEVR right here, you had Take-Two Interactive. I actually mentioned with them earlier in this video. And you can see Take-Two Interactive runs Grand Theft Auto Online, and it's rated M for mature. It's got blood and gore. It's got mature humor. It's got people without their clothes on, I guess. I just don't want to use that word on YouTube and get flagged or something. You get the idea. Here's another fund, Timothy Plan. This is another provider of Christian based ETFs and mutual funds. Well, Southern Company is one of their holdings, and well, there's that. I mean, they've got a whole page on this on their website about this issue. So, this is hard because this is the direction the country's going, and as Christians, it's important for us to be loving, and it's also important for us to be clear in our moral stances. So again, this is an investing video, and my fear with this level of screening, if you're going to say, hey, I can't have any LGBT promotion, like promotion at all in one's funds, in the holdings in your mutual fund, in your ETF, that you're just not going to have a whole lot left, because this is probably going to be the vast majority of the S&P 500 and a good chunk, if not a majority, of international stocks as well. Okay, so I am back for what is hopefully the last recording session of this video. I'm hoping my son stays asleep here. We're looking at BIBL here. It is the Inspire ETF that I believe has the most assets under management. And you look under here. Well, does it have assets under management here? That's not it. I don't think so. Okay. So what they seem to be doing, if I understand everything correctly here, is they've got all these insight scores. And I told you these insight scores might not make the most sense, but they're looking at these insight scores and they're finding the ones with the highest ones, and they're constructing an ETF out of it. So we've basically covered kind of the three aspects of ESG in regards to that. Because if you go back to, let's go back to the Guidestone page. So remember this Guidestone page here where it says, okay, here's faith-based investing. Screening is the first step. Okay, we're going to take out things that don't make sense to be here based on our values. And Guidestone has their own screens that we showed were not very effective. Inspire has screens that are a lot more effective, but might not be entirely consistent. And then we saw, hey, advocacy is the next step. We engage with the boards. Inspire's CEO Robert Netzley made a point of that in his interview with Eric Metaxas that I thought made some pretty good points. I'm not an Eric Metaxas fan, by the way. But I thought Robert Netzley made some good points in that interview. So if you want to go find it, go find it. And then the third aspect of this is this concept of impact investing. And I just don't see that being effective. If you look, for example, let's go back to here's BIBL. And you look through this, and it's like, okay, investing involves eventually, in a broader sense, when you collect a lot of people's investment funds, it involves providing capital for businesses to do things, and a lot of those can be good things. Economy is a good thing. People having jobs is a good thing. Now, should this give you like the biggest warm fuzzies to be in these particular companies? I think you really need to know more about these companies to really know that. Guidestone has their own thing going on here in regards to that. You can click here in their faith-based investing page, and it says, learn more about impact investing. And it's got, hey, we donated to send relief to send medical supplies and vitamins to the most underserved parts of Venezuela. We provided funding to the Prestonwood Pregnancy Center. Okay, those are both very good things, but I really have a problem. We conflate that with this concept of impact investing. It's like, hey, we're going to stick stuff in this particular mutual fund or this ETF and conflate that with the same thing. Hey, this is impact investing. Okay, if you want to be charitable, be charitable. Well, we're called to be charitable. We should be giving to people who are in need. We should be providing support to things and to people that need support. This is not impact investing. This is charity. And charity is good. Charity is necessary. Okay, I love pregnancy centers. I volunteered at one in Arlington, and it's great. And then we conflate this with the Guidestone Global Impact Fund. And then you click on this, and it's a mutual fund, and it's got 60% stocks and 40% bonds, which is pretty conservative. That's like a retirement level of aggressiveness in the portfolio. It's got a fee of 1.21%. So, okay, somebody's making money in regards to this impact investing, not the guys who run the charity who get paid pennies to work at a charity, that kind of thing. You can look at the holdings here, but let me show you the Vanguard Morningstar page for this. You can see a 1.21% expense ratio. That's really high. Okay, that is an old level standard of fee. And you click over to portfolio. Whenever you're on Morningstar and you find a page here, I think your next click should pretty much be portfolio. It's not even the performance, it's the portfolio, because the portfolio is going to drive the future performance. And as this loads, maybe I should have loaded this beforehand. Oh, are we even going to load today, guys? You're killing me. Oh, the spinning clocks of death. Spinning clocks of death. So eventually we're going to see stock style. I saw earlier there that it's a large growth fund. So probably more growthy than the S&P 500 on the stock side. And then we can see the effective durations of the respective credit ratings of the bonds in the portfolio. And then we can see the actual stocks that these are invested in. And there are only okay, so in viewing 1 to 10 of 19, maybe there are more than 19 stocks here because it shows 346 holdings. So maybe I got that part wrong. But in any event, okay, if you're talking about impact investing, hey, we're going to make a positive impact. Is Microsoft the company that you think of when you think impact investing? Or Westinghouse Air Brakes Technologies Corporation. Okay, they make brakes for freight trains. Brakes for freight trains in terms of global impact. making a difference. NVIDIA, making semiconductors for video game graphics cards and semiconductors for cryptocurrency mining. Global impact. I don't buy it. I'm sure there are good people at all these companies, and there are good things that they do, but to conflate this with donating to pregnancy centers, no, don't do it. I don't buy this impact investing thing at all, really, because I could just as easily argue for that in an S&P 500 index fund, and check it out. Microsoft is already 6% of that, and Apple, is not a perfect company and does not always advocate for the right things. And you know what? You probably own an iPhone. So you've already, given your money to the Apple anyway. I own an iPhone. My wife owns an iPhone. I own an iPad. I own a MacBook. This is not on a MacBook. This is on a Microsoft Windows computer. But we're gonna have consumer habits that put money into companies that do things that we don't like. And so trying to say, hey, I have to do these Christian mutual funds, or you have to do these Christian mutual funds, it's really hard to hold that consistently. And we certainly don't want to conflate charity, actual charity, actually giving money sacrificially to say, okay, this money is not mine anymore. I am a steward of God's money, and this belongs over here. And to conflate that with a global impact fund and go, ooh, I'm making a difference, and you get these warm fuzzies for your investing. Okay, you can make all kinds of arguments for every single one of these companies. Yes, even the oil, even the payment processors, the pharmaceutical companies, where a majority of these pharmaceuticals are doing good things. You could argue that for Home Depot and so on and so on. So I can understand the screening out immoral companies by certain standards. Okay, Romans 14. I can understand certain aspects of ESG. It depends on your views in terms of whether these environmental, social, and corporate governance criteria are things that you really are interested in. It's also a matter of whether you're trying to reduce your ESG risks and you're saying, hey, the government is going to go after these oil companies and I want nothing to do with them. Okay, that's an investing decision that you need to make. And I kind of draw a line at impact investing. This idea that you can be charitable and be investing and conflate the two. No. That's kind of where I draw a line. So let's kind of summarize what we've been through in this video. I want to make sure I pull up my notes. So one, do the underlying dynamics of investing, whether it's with an ETF such as this one, the Vanguard 500 ETF, or the mutual fund share class, or wherever else. Do these underlying dynamics mandate an ESG or other type of sustainable type approach? And my answer to that is no. Based on what funds do and how things are traded on the secondary market, I don't think it makes you culpable that companies within your investments do bad things. Now, that said, Romans 14 means I don't throw you under the bus, and I don't think anything less of you if you have a different opinion on that. Two is if there is such a mandate, or you have a conviction other than mine that you said, okay, I really do need to screen these things out of my investments. I would say it's very difficult to do consistently if you have a secular employer, if you have a bank that lends money to places that we don't like, to places that do things that we find to be evil, etc. And then finally, do Christian investing products, such as those coming from Guidestone, like Guidestone here, or with Inspire ETFs, such as BIBL, that kind of thing. Do they accomplish what they claim? And a lot of that is going to come down to the investor's own judgment. And so my best advice to you is you have to look at the holdings. You have to look at the holdings and know what you're getting into. And you should be doing that anyway outside of the moral question, because you can't stick to an investing strategy unless you know what's in there and what's going on. And so you see something in the news and you kind of know, okay, well, this is what my investments are going to do about it. And so I'm comfortable with it or I'm not comfortable with it. And then finally, I have basically a couple of pleas, PLEAS, in regard to this. One is, if you are an investment professional, like you're a business person and you've made it to the end of this video, I very much appreciate your ear. I very much appreciate your ear to this issue. And my plea is that the ideal product that Christians could really get behind simply does not exist. I look at a product like Guidestone Equity Index, and I see all kinds of good potential because, let's face it, okay, I made the argument that as an individual investor and you're not high net worth, that you're choosing a fund like this one just isn't going to make a dent. But if enough of us get together, we really could make a dent. We really could make it more difficult for bad companies to raise capital. We really could make it easier for companies that don't do those kinds of things to raise capital. And so you look at something like this, an equity index fund, where the fees could be lower. Guidestone could lower their fees simply by opening ETFs. And I don't know why the fee is as high as 0.39. It doesn't make sense to me when you have smaller funds charging less, even though they're not index funds. So I just don't buy that Guidestone is keeping their fees as low as they can. I also don't buy that they can't do stronger moral screening. So my plea is for Christians who are in the investing industry, or even at Guidestone in particular, we can do a lot better and perhaps make some positive impact by putting out a product that really does have a stronger moral screen. I don't think you can go as far as the LGBT thing, because that is just too broad, but you can certainly put something together and then engage with corporate boards and tell them what's really going on in our minds. And the second plea is really the gospel, that we've all violated God's law, and we see the result of that. We see the result of the fall. We see the ever-increasing rebellion against God's rule and God's law. And Jesus Christ paid the price for all of that sin. He lived a perfect life in our place. He kept all 10 commandments perfectly. He lived in our place. He died in our place, and he rose again so that all who would ever believe in him would be saved. So that all who would believe on him would have their sins placed upon Jesus, would have their sins placed upon the cross, and the righteousness of Jesus Christ, the perfect righteousness of the Son of God, would be placed upon us. And he rose again, proving that he is who he says he is, and the Father has accepted his sacrifice. So if you're watching this and you've made it to the end, I really, really do thank you for your ear. And I implore you, if you have not come to know Jesus Christ, please come to know him. Please repent of your sin and place your trust in him. Contact me if you have any questions about that. That is the video. I hope I covered all of the topics that I wanted to cover. But there's a lot going on here. And as long as you're going to be invested, it is important to understand what's going on underneath your investments so that you can hold on, so that you can achieve whatever you're trying to achieve financially, and that's going to be a sound plan. It's not about getting rich. It is about, sound planning, and sound planning is certainly a biblical thing. Thank you very much for watching, and I'll see you in the next video.